Warm welcome to everyone who has joined us today. My name is Piyush Tiwari. I'm Professor in Property at the University of Melbourne. Before we begin, I would like to acknowledge the traditional owners of land I'm on today, the Wurundjeri people, as well as the traditional owners of land you are situated on, and acknowledge that Indigenous Australians have been custodians of lands and waterways of Australia for thousands of years. I pay my respect to their elders past, present, and emerging. In this first part of three-part Urban Land Institute University of Melbourne series on foreign investment in Australian property, we'll discuss residential property markets today. I would like to highlight that the discussions with the panel today would feed into the forthcoming ULI Asia Pacific Summit from 17 to 22nd May. Information about the summit could be accessed through ULI website. Various events of ULI will be on display at the end of the webinar. Please do take time to take note. Let me introduce the panel. We have NERIDA CONISBEE. She is Chief Economist with REA Group and one of the leading property market experts in Australia. She appears every Saturday morning on Sky News, is a regular property commentator on Channel 7's Sunrise, and talks more generally about the state of economy on the ABC News Breakfast. Welcome, Nerida. Our next panelist is Rod FEHRING. He's Executive Chairman, Frasers Property Australia. Rod brings with him 40 years of experience in urban development in both private and public sectors. His recent experience as CEO of Frasers Property Australia oversaw the residential, retail, commercial, industrial, and logistic property development projects of the firm nationally. He is passionate about sustainable development, social well-being, and diversity, which he reflects in his work. Welcome, Rod.
Good afternoon, everyone.
Our third panelist is Peter Chittenden. He is the Managing Director, Residential with Colliers. Since joining Colliers 9 years ago as Managing Director of Residential, Peter has grown the company's residential division by more than 300%. His 30 years of experience in real estate as National Sales and Marketing Management for Stockland and his own successful marketing company, Realm Project Marketing. Welcome, Peter.
Thank you.
We also have Associate Professor Sam Tsiaplias. He is Principal Research Fellow at Melbourne Institute of Applied Economic and Social Research. Sam is a Principal Research Fellow in the Macroeconomics Research Program at the Institute, and his research focuses on applied macroeconomics, housing and household behavior, and financial economics. He has consulted a large number of government agencies and private sector organizations. Welcome, Sam.
Thanks, Piyush.
Some housekeeping things. Please post your questions as we go along. We'll try and take your questions during the discussion, if possible, or towards the end of this webinar, if time permits. So without further ado, let me invite Nerida. Nerida, we have seen through the turbulent 2020. However, the first quarter of 2021 has shown some fantastic results for the economy and the property market. With your finger on the pulse of the residential markets in Australia, could you take us through the market condition and tell us if the fears of house price decline that we had last year have been alleviated? Nerida, I believe you would want to share your slides as well.
Yeah, okay. So today what I'm going to be doing is just taking you through how foreign investment in Australian residential real estate has changed over the past 5 or so years. As Piyush said, the market is moving really, really red hot, and we can see that price rises are apparent pretty much everywhere in Australia. We've had a shift to regional areas. Prestige property is doing incredibly well. But one thing we haven't yet seen is a mass return of foreign investors in the same way that we saw them in the market back in around 2017, 2018. So I'm just going to talk through some of the things that we're now seeing with foreign investors. And I'll start first with the FIRB data. And the FIRB data, unfortunately, only takes us up to 2019. And Already at that stage, we had started to see a decline in their activity. So new dwellings are overwhelmingly the dominant type of property that foreign buyers are purchasing. Vacant land as well is also a much smaller option. Foreign buyers can buy established dwellings, but only if they plan to redevelop them into multiple dwellings. So that's why we do see that as a component of the Foreign Investment Review Board data. The biggest reduction 2018 to 2019 was in vacant land. New dwellings at that stage were starting to come down, but they weren't coming down as quickly as what we'd seen in vacant land and also established dwellings. In terms of where they were buying and where foreign buyers were buying, or based on the Foreign Investment Review Board data, no surprises. The bulk of the activity was in Sydney and Melbourne. We did see a little bit of activity in Adelaide and WA, but it really was very, very focused on our two major cities, and that reflected in the levels of development that took place over that time. If we have a look back to that time period, there was enormous levels of apartment development, and really driven by very strong interest from foreign purchasers. Unfortunately, we can't break this third data down into countries. They do publish country level data as to where people are buying from, but they combine it with commercial properties. So foreign purchasers, foreign buyers are very active in the Australian commercial property sector, and because of the very bulky nature of a lot of commercial property transactions, they can be certainly in the billions when they are transacted. They do tend to skew the numbers. So I think the top country came out as the US in 2019, primarily because of some of these really big commercial property purchases. But we certainly know that on the ground, when people were selling apartments, that it was primarily Chinese buyers, Hong Kong, Singapore. They were typically the three top purchases that took place during this time. In terms of what the pullback of foreign buyer activity has done to development, you can see here building approval data over a prolonged time period, and really the black line shows new apartment approvals. So we did have this incredibly strong run of development that took place between 2015 and 2018. It really peaked, as you can see there, in 2018. But as foreign buyers pulled back and as local investors has also pulled back, we had the Financial Services Royal Commission. So all of these things did combine to see far less development taking place. We did see a bit of an uptick during COVID. It was driven by home builder to some extent, but we also started to see investors, particularly local investors, come back into the market towards the end of 2020, which is starting to make a difference to the level of development that will take place in 2021. So this is data that we get from realestate.com.au. So this is a little bit more real time in terms of what's happening. What we can see, we can track IP addresses, so we know where overseas property seekers are coming from. What we saw over the 2020 period was that we did see a pickup in foreign search, except from China. So you can see there the US obviously going through some pretty big occurrences in 2020, not only high levels of COVID cases, but also a fairly shaky political system, quite a big pickup there. We also saw a big pickup from Hong Kong. So anecdotally, I know Peter and Rod will be able to talk to this, but anecdotally, we have heard that a lot of Hong Kong buyers are very active at the moment, and in Australia. What's quite interesting about Hong Kong search activity from our perspective is that they look at very, very expensive properties. So typically what we see is overseas property seekers look at quite cheap properties, certainly well under 700,000. Hong Kong property seekers are looking at a far higher price level. The Chinese drop has really been occurring for a long time. So it pretty much matches what we've seen from the FERB data up to 2019, which also saw this gradual decline, but then it just kept declining over the 2020 time period. And we are now at the lowest levels of Chinese search that we've ever recorded. I think what's quite interesting about the Chinese buyer activity is that they're not necessarily inactive in other markets. And we have a portal in Malaysia called iProperty. And what they're saying is that there's still quite a lot of activity coming out of China, but what their developers in Malaysia have had to do is target the pricing very specifically at 150,000 US. They've also been giving payment plans to people to pay 50,000 per annum so that they're able to get the money out over a 3-year time period. Obviously, that's not possible in Australia. We don't have such cheap property to be able to sell it at that price point. But, I think the kind of, I guess, the general view is that Chinese buyers are nowhere is not true. They're just not in Australia. And there's lots of reasons for it. I mean, part of it is difficult for them to get finance. It's hard to get money out. A lot of Chinese developers pull back with the Belt and Road policy. So they were no longer selling back to their own networks. And then also the additional taxes that were put on foreign buyers were really off-putting for a lot of Chinese buyers in Australia. Another interesting thing at the moment, we are anecdotally hearing of a lot of very, very strong expat activity. So that may explain a little bit the Singapore interest and certainly, potentially the UK interest that we're seeing. But obviously expats are typically able to buy established property, so it doesn't have such an influence on new development. In terms of where we see overseas property seekers looking, they do tend to stick to areas in which there are already a high proportion of people from born in that same country. So somewhere like Glen Waverley in Melbourne already has a very, very high proportion of Chinese-born residents. When we look at Chinese property seekers at the moment, Glen Waverley is number 1. What's quite interesting about the Asian search at the moment, so if you have a look at Hong Kong, Singapore and China, particularly China, during sort of 2017, 2018, the top destinations where they were searching were very focused on education locations. So Carlton, Clayton were coming up as number 1 and 2 for China for a very prolonged time. But that's changed. They've dropped right down. So it is, lots of reasons potentially, but they do seem to be switching back to places where there are already a high proportion of residents from that country. Elsewhere, if you go outside of Asia, you can see how much people from overseas love our beaches. The UK, Noosa coming in at number 1, Byron Bay number 2, US Byron Bay, New Zealand love Noosa as well. I think one of the interesting ones is Byron Bay. That really didn't feature much for a prolonged period, but it is now coming up primarily because it does have international profile now. So that's also something that seems to drive activity. Having an international profile, sort of like I guess a celebrity suburb, does seem to make quite a difference to overseas search. In terms of the projects that people are looking at from overseas, you can see here that these are the most viewed in 2020. They are premium, they're very expensive. And again, this is very different to what we were seeing in 2018. So we're no longer seeing the, the high development investor grey stock being the most looked at projects. And again, that reflects, the switch from people from that Chinese-led investment boom that we saw quite a few years ago to more of an owner-occupier, expat, higher wealth kind of activity that we seem to be seeing at the moment. In terms of one question I know that came through when I posted on LinkedIn was around how does this impact your Melbourne CBD? How's that been impacted by COVID? And I guess it is of interest because it was such an area of very, very high levels of activity during 2017, 2018, even several years before that. And one of the things we can see is that Melbourne in particular, has been ground zero in terms of the very, very large increase in vacant apartments that's taken place during COVID. It has come down a bit. So this is up to March 2020. If we take it to December 2020, I think we had more than double those number of apartments available in Melbourne CBD. So it has come down quite a bit. But what we can see now is inner Melbourne accounts for around 3/4 of the increase in vacant apartments since the pandemic. So a lot of things, probably two main things driving it. It is a market very dependent on students, particularly foreign students, but also local students. So obviously there's been issues there. And also just the sheer number of apartments. So that did make a difference to the number of properties that were available. So another interesting thing, you can see there how Melbourne-centric this list is, and really being driven also by the fact that Melbourne went through that prolonged lockdown, which again led to some pretty terrible situations for lots of CBD retailers and office owners, but also people that owned apartments as well. Although we are seeing these really, really big increases in units available for rent, we're not really seeing it flow through to incredibly strong levels of transaction activity. So, we're not seeing any levels of distress in the Australian property market at the moment. We're not seeing, what's quite interesting, we track every month the number of distressed properties and that are listed on realestate.com.au, and I think there's only about 3 properties. So, if you have a look at the number of properties on the site, there's over 160,000. So there's the residential market is being supported by very low interest rates and also a very rapidly recovering economy, and also the fact that people just built up these incredible levels of wealth during COVID, primarily because they weren't spending much money. I'm just going to finish with some really interesting research that was done by NREV. So they're an industry body that represents pension funds around Australia, a lot of institutional investors. What was interesting about their most recent survey was how much Australia featured. When we have a look at the 3 investment destinations in Asia Pacific, Sydney comes in at number 1, Melbourne number 2, Tokyo at number 3. Also interesting, obviously, for this discussion is the preferred sectors that they want to be in. So even though there are some pretty dire issues for the office sector at the moment, office is still very much in demand from overseas investors. Industrial is still popular, and coming in through what they call residential, which is really development sites, is still a preferred sector by many global offshore investors. And whether that's for the build to sell model, or also the build to rent model, which is also gaining traction. So I'll finish there, and then I'll pass it back to Piyush to talk through the panel. Oh, Piyush.
You're on mute.
Piyush, I think you need to unmute.
Yeah. All right. Okay. Yes. Rod, please. The question to you is that why has the residential market held so well compared to other commercial property?
Well, I think the first thing to say would be that the stimulus that's being directed, particularly at the detached dwelling segment of the market, translates fastest into new commencements and new activity. The same stimulus directed into high density apartment type product with planning constraints and just the time to move through pre-sales, etc., means that that's a far more lagged response, which will take 1 to 2 years to materialise, if indeed it does. So the primary reason is that it's speed to market, which is a product of the efficiency of the housing construction industry in Australia.
Right. And what type of residential assets are more likely to come on the market during 2021 and 22, and why?
As a development product?
Yes, as a development product.
Yeah, okay. Well, I think if you just go across the sectors, and I think that NERIDA's last slide indicated, the popularity and the strength in the industrial market is very, very strong. So having said that, though, the supply of industrial land in the two major markets, Sydney and Melbourne, is quite constrained, with the possible exception of Western Melbourne. So I think there'll be more of that. What can be developed will be developed in very short order. I think office development has seen a strong resurgence on new project side of the equation, but again, the gestation period for new office projects is relatively slow. But I think the build to rent, the amount of new activity in the build to rent sector, we don't really have a build to rent sector in comparable terms with the UK and the US. What we have is a build to sell to rent, build to rent to sell sector at the moment, to a large degree. And I think there's a fair bit of, if you like, speculation that ultimately the yields in that segment will be adjusted as new investment treatments from a tax perspective start to get introduced at state and federal level. I think there's still risk around that, quite a deal of risk, particularly at the federal level in terms of tax treatment. So I don't think that the build to rent sector in a look-like, seems like equivalent to that which exists in markets such as the US is necessarily going to be seen in Australia in the near term. So I think there's risk around that aspect.
Right. So let me ask Peter. Peter, do you concur with the view of NERIDA that the market is doing fantastically well, or are there some segments of residential market that you see are still distressed following the pandemic?
Well, look, no. In short, our anecdotal evidence says exactly what NERIDA stats do, and that is there'd be very few distress properties, and there's always some people in personal distress, and that's probably what accounts for it rather than anything related to the pandemic. We've just seen consistent sales. During the pandemic, we actually just saw less stock in the market, and so therefore less sales, but now there's more stock and more sales.
All right. In the overall game of residential property market in Australia, how important has the foreign investment in Australian property market been over the last decade?
Well, it's been critical for governments to deliver on their promise, which is to have budgets that create jobs. And what foreign investment does is it supplements local investors and owner-occupiers to put numbers into our developments, particularly new developments, which is where they have to go to. So, to maintain a growing number of residential development business throughout the country, it is absolutely critical. But importantly, what we need to do as a country is determine what we want, and do we want it, and do we want it consistently, and to what level? I think where the impact is when, as we saw only 4 years ago, we were stating that foreign investors were pushing prices up, affecting the first home buyer, and having this artificial effect. Therefore, we chased them out with increased stamp duty, which meant they scurried away, particularly the Chinese, as NERIDA mentioned. And now we want reinvestment into that space, but we're going to need them. So I think as a product and as an economy, we need to be a little bit more consistent about what we need and what the true story is.
Right, okay. And Peter, could you further elaborate on what NERIDA was saying earlier about different types of investors, different nationality of investors, and what attracts them to come to Australia and invest in Australia?
Yeah, well, I mean, we see people from all sorts of countries around the world, but absolutely China, Singapore and Hong Kong. Our Hong Kong inquiry is the highest at the moment, and the Chinese have dipped away. I think it's definitely supported from the Chinese government, where they're discouraging any money to come over here at this point in time. I don't think that'll last forever. Sorry, I've lost my train of thought. So yeah, Sorry, lost my train of thought.
No, that's fine, Peter. And I was wondering if there has been any surge in investment from UK, particularly after Brexit.
Oh, sorry. Yeah, not necessarily. I mean, what we have seen from the UK is really just expats more than anything else. But the and majority of that inquiry coming through realestate.com, we're really seeing as expats more than anything else, just due to it's just the pricing of stamp duty at the moment is a little bit heavy for them.
All right. Okay. And has the investment activity changed over the last few years, 2018, 2019, and after the pandemic?
Yes, it has. It's diminished. We as a project marketing business, and we particularly do mostly apartments, it has changed. It's dropped significantly back. Our Melbourne business in particular relies on that. We probably sell 80% of our stock to offshore people. And so that has diminished substantially with that. So, it's critically important.
All right. And are there any unintended negative impacts that are observed as a result of requirement for established dwelling being purchased only for the purpose of multi-dwelling redevelopment? Do you see them?
Sorry, can you say
This is a question from participants.
Sorry, say that again. Sorry.
Has there been any unintended negative impact that you observe as a result of requirements of established dwellings being purchased for the purpose of multi-dwelling redevelopment in established suburbs that we?
No, not really, no.
Right, okay. Now, let me go to Sam and get some filler about the economy. Sam, how is the Australian economy likely to compare with the rest of the world over the next 5 years?
I think to answer that, it's good to look at where the economy has been. So I guess in the past few years, growth has been patchy. And by patchy, I mean that growth has been sort of weak in some sectors and strong in others. In terms of the strong sectors, I think households have performed quite well. So household consumption, which makes up about 60% of GDP, that's held up remarkably well during COVID, better than most forecasters would have expected. Not only consumption, but more specific things such as retail spending, they're currently growing at double-digit rates. The unemployment rate has fallen. So those parts of the economy have done well. In terms of the weaker parts of the economy, I think it is business investment. For example, lending to businesses is at very low growth rates, very close to 0%. And I suspect in the short term, that will continue to be a factor where households rather than business investment prop up economic growth. Longer term, I think the key question is, how well will fiscal policy be able to reflate the economy? And so by reflate, I'm thinking of a situation where for quite a few years, we've had weak inflation and weak wage growth. And that obviously inhibits economic growth going forward, and it will inhibit the capacity of the Australian economy to outperform other economies. Now, in order for reflation to occur, the current paradigm suggests that the unemployment rate has to fall. So it's fallen from a maximum of about 7.5% to less than 6%, but that's still way too high for reflation. I think most economists would say that we need the unemployment rate to be around 4% for reflation to be a meaningful type of reflation. So to have increased wage growth, for example.
Right. Thanks, Sam. NERIDA, can I ask you, does this outlook of economy that Sam has presented pose a caution for the property markets in any way?
Yeah, look, I guess the biggest challenge at the moment is that the market is moving very, very quickly, and it does lead to a sense of nervousness amongst people. I think there's a general perception that property portals and real estate agents are really happy when the market's, galloping ahead at 10, 15% per annum. But the reality is that what happens is people do stop making decisions. They get very nervous, and they get nervous primarily because most sellers are subsequent buyers, and if you sell your home in a very, very hot market and it takes you a little bit of time to buy again or find a property to buy, you can really be in quite a dire position because prices can have moved ahead quite rapidly during that time. So I think, in terms of and then there's just affordability issues as well. Broadly speaking, Australian property is incredibly expensive. We're the second or third least affordable country in the world. Sydney is ranking number 3 at the moment in terms of very low levels of affordability. So there's some real challenges just generally about that, and there's challenges around debt levels, and it goes on and on in terms of some of the challenges. In terms of what will slow it down, look, at this stage, it's just belting ahead. We can see that the prices being achieved are incredibly high. I mean, in some parts of Sydney, anecdotally, it seems that properties are gaining, up to, not properties, but, some properties that, may have sold for sort of 3 mil 2 months ago are starting to achieve levels of 4.5, 5 mil. And that sort of price growth does lead to a bit of nervousness amongst people, and particularly those looking to buy. So in terms of what could slow it down, obviously an interest rate rise, that does seem unlikely at this stage, particularly given what Sam was saying about unemployment and, what will happen to inflation. So it's unlikely to be something that will occur in the next 6 months. It is possible that our pro will start to tighten lending. I mean, it is very easy to get a loan at the moment, and banks are being super competitive, and there's cashback offers, and, it's possible to get loans under 2%. So, they may tighten up stress tests. They may tighten up, loan to value ratio requirements. There could be quite a few things potentially that they could look at. The third option would be making some changes to taxation. So, whether you do something around negative gearing or some of the first home buyer incentives, potentially we could see something happening there. But, at this stage, I think that seems unlikely. I don't think anyone is at the moment thinking that investors are a problem. They've just come back into the market. We're certainly not thinking, no one ever really thinks strong first home buyer activity is a problem either. So I think they'll probably leave that alone. So I think realistically, sometime this year, I think it will be some restrictions on how banks lend, and that very, very loose way that they're lending at the moment. I think that will probably be tightened up.
Right.
Do we have any evidence about that lending being loose, or is that anecdotal?
Yeah, mainly anecdotal. If you have a look at some of the cashback offers that are being provided, we own a mortgage broking business, and they're certainly saying that there is a lot of, it is a lot easier. And then I guess the budget last year also put a relaxation on responsible lending rules, and that was something that was brought in quite a few years ago, where it was seen as the bank's responsibility to lend appropriately, but now that change that was put through the budget really switched it around to say, no, look, it's the responsibility of the individual when they are going to get a loan. So, on one hand, banks do need to be careful anyway, because obviously they don't want to lend to someone that can't pay it back. But, things that we were hearing, prior to COVID about people having to show detailed expenditure on their MasterCard around how much they're spending on hairdressing and alcohol or whatever, that sort of high level of detail just doesn't seem to be quite in place as it was prior to 2020.
Thank you very much, Nerida. Peter, can I ask you one question? This is coming from participants. Is there a concern that the RBA will be forced to raise rates prematurely before 2024 if the bond rates keep rising the way they are? Is this factoring into investor decision making at the moment, since residential prices here have already increased from such a high base?
I think interest rate, there's a lot more than property values and things to take account for. And I would doubt very much that there's any other, and there's worldwide influences and things. I can't see that they will. I've spoken to some people in banks and other reasons. They don't want to act quickly and without any, economy. So we can't see that happening for, up to 3, 4 years at this point in time, based on all the people we've spoken to.
Well, I think the Reserve Bank has explicitly said that they're not going to move on rates for several years. So
They've said until 2024.
Yeah, barring
So
some kind of extraordinary reflation, that doesn't look to be on the horizon, save for some kind of massive fiscal stimulus that again doesn't look to be on the horizon. It's very unlikely that rates will rise, at least in the next few years.
Yeah, Sam, can I ask you another question related? The impact of government stimulus on residential property market. Do you see that that has played also an important role in the way the prices have risen in the last few months?
Look, I think the main factor is that monetary policy is at record expansionary levels. So interest rates are basically at the zero lower bound. And history has shown that when there's a period of aggressive expansionary policy, households react to that. So that there are models that have been built that show that households sort of overreact to expansionary policy. And if you estimated those models, you would get basically a prediction that is consistent with what we're seeing right now. We're seeing that type of overreaction in demand for houses and house prices, and in effect a schism between what fundamentals would suggest the fair price should be and what people are paying. And I think that is the key factor. In terms of the impact of stimulus, I suspect stimulus has helped transition the real estate market and the residential property market rather smoothly across a very volatile period. So it's helped renters pay their rents and people pay their mortgages. But I don't think it is a dominant factor in what we're seeing in the last couple of months.
Right, okay.
Yeah,
But there are some dampeners in the economy, isn't it?
Yeah.
Like, for example,
it's certainly important. The purpose of fiscal stimulus is to help smooth the economy out through a difficult period of time. And I think more or less it has achieved that. And although there are sectors of the household sectors that have experienced severe loss, the average household has fared better than expected during this period. And that's helped stabilize the housing market and rental markets and so on. But it's difficult to see that that has caused the big rise in demand that we've been seeing in the last few months.
right, okay. But how about the dampeners in the economy? Like, for example, the international students cannot come, the migration hasn't happened to the extent it used to happen in the past. So are they playing some negative role in the housing market?
Well, I mean, I suspect those factors are important for areas where students reside. So in the data that NERIDA showed, she showed that there was a downturn in activity in Clayton and Carlton. And those are obviously two very big hubs for universities. And my opinion would be that it would be in those areas that most of the impact of a shift in student numbers would be felt, and that would make sense.
I just add to that, we've developed in Chippendale, which is within a kilometre of University of Sydney, UTS, and Notre Dame University, over the course of the COVID period over the last 12 months, running through to March, rents in that location have been down 25%, and occupancy rates have been are running at around about 75 to 80%. In Carlton, which we've developed in as well, we have assets in that location. Not as deep in terms of the rental discount, but rental discounts there in order to get tenants into accommodation are running at around about the 15% thereabouts. So I think I have a different view that the loss of students in the CBDs, particularly of Sydney and Melbourne, has been a significant impact on the market and will continue to be a drag until we have some form of stabilised resolution about how students actually recommence their studies in Australia, if indeed they do at all.
Right, okay. So does that mean that there will be different impact at
Yes.
the sub-regional level
Yes.
in the property market?
It's quite spatially where it plays its impact.
Okay. Right. Rod, can I ask you one other question? Has the development sector been affected by availability of credit in any way?
Oh, look, I think you have to divide the development sector into developers and builders and consumers. From a consumer's perspective, we're still seeing time, a lot of time taken in converting from, in getting qualified for finance. So a little bit different to how NERIDA is seeing it, in that the length of time that people are taking to secure actual finance is extended. Typically that would be around a 6 to 8 week. Now we're seeing it at about a 12-week duration. So that's on the consumer side. In terms of foreign investment and availability of capital, debt funding, there's no shortage of debt funding available if you've got a balance sheet to support it. And so I think there is a stratification, if you like, on who gets to lend on what terms. From a foreign perspective, and certainly from a domestic perspective, the number of fledgling and new entrants to the lending market and mezz finance, etc., has been quite extraordinary, because that's frankly where you're making as much, if not more, in terms of return than taking a development risk. So I think that's going to play itself out. I think the strength of the market has been quite surprising in terms of its recovery over the course of the last 6 to 9 months. And as a consequence, I think the borrowing will become far more discretionary because the opportunities to be able to exploit a set of circumstances where there was a credit crunch have now dissipated. Finally, though, having said that, in the building delivery side of things, construction finance is still very difficult to get, depending on who's borrowing. So again, that stratification process is playing itself out in the market.
Okay. So what do you see as the current and future status of institutional fund available for investment, like for example, pension fund or sovereign fund, and their appetite for residential markets?
Yeah, look, their appetite for property, full stop. It's not specifically residential, but Australia is continues to be a very attractive location for investment for the reasons that NERIDA included on the last slide, particularly from the point of view of the transparency of this market. Although damage has been done with the way FIRB controls have changed. The introduction of, and that's introduced a sort of a smell of sovereign risk, which has not really been something associated with Australia in the past. And similarly, also the continued surcharges that have been applied, which were originally applied again, and this is affecting developers and institutions as much as it is affecting consumers. The way these surcharges have been introduced and the legislature used to introduce them was hastily put together. It was put together at a time when, and the sort of numbers that I've seen, when you're talking about residential representing applications from FIRB, as NERIDA has indicated, being 80–90% of total applications, the legislation put in place to effectively tax buyers at the time was done quickly. And as a consequence, it's introduced unfortunate circumstances which are still having to be played out. My concern about that is that the taxing of the production process, which by implication, that's what's happening now, is effectively having an effect of making residential less attractive than it has been in Australia from a foreign perspective. Other sectors are becoming more attractive because the complications around surcharges are less cumbersome and less, if you like, accidental than what we've seen. I mean,
Right.
Silly example, but situation in, again, where one dwelling exists on a property which is not zoned for residential purposes, it's zoned for rural purposes, but has a minimum lot size of 15 to 40 hectares. That is deemed a residential transaction, and so therefore stamp duties will be, surcharges will apply to that transaction because there is a residence on it. It's deemed to be speculation in residential, even though the intended use is for industrial, commercial, or infrastructure, or some other use. That's how cumbersome and unfortunate some of the legislation is, and it's having an impact.
All right. Okay. This is a question from a participant. The NSW government is proposing replacing stamp duty with an opt-in annual property tax. Should foreign surcharge duty be eliminated to encourage more foreign investment in the state? If not, is an additional annual surcharge like property tax on top of the existing land tax surcharge be more appropriate?
Well, what would you expect me to say? I don't think the surcharges are appropriate. It's what Peter said before. I think these signals are actual. Australia is an importer of capital. And I think these signals are, while they're not dissimilar to how Singapore is handling this, how New Zealand is handling it, how Malaysia has been handling it as well. I think for a country like Australia, which has got an open economy, not a controlled economy, which relies on foreign investment in order to balance out its overall capital needs, because we're still a young and growing country. I think in those circumstances, we have to be very careful about what messages are sent offshore. Australia gets itself into enough trouble in our geography, in our region within the planet, by taking positions which send very mixed signals to offshore partners in the Asia Pacific, particularly through China, Hong Kong, Singapore, etc. So I think we need a much more considered, less haphazard, and open-minded approach towards the role that foreign investment plays, not only in the residential sector, but in the Australian economy broadly.
Right. Okay. So do you think that the foreign investment in Australian residential property market would reach the similar levels as we have experienced in the past?
Unchanged circumstances, no. Other sectors and other locations are being looked for.
Right. Okay. Okay. Peter, may I ask you, like, do you think that where we are at the moment with regard to residential property, are we in a bubble, or is it likely to change in the coming future, given that there is a possibility that many of the things, that there are vulnerabilities in the economy, interest rates are likely to rise, may not be in the near future, but it will. So do you think that are we in some sort of bubble again?
No, I don't think we are. I think that we're in a situation where we've had diminished supply. The residential market consistently for decades has been a pretty safe medium to long term. I don't want to use the word bet, but investment of where to place your money. Hence the interest from overseas. Rod talked about it. We're a transparent marketplace. It's a safe bet. So I just think with, clearly the pandemic locked everyone down, but then prior to that, because we came off such a boom, more impacts and more restrictions with banking and stamp duty and things really scared everybody. And then I've realised that the sky isn't going to fall in and they've all popped out hard. And what we tend to find is in a rising market, everyone jumps in far faster than a slowing market, and they will pay more. So, there will be hot spots, but what I like about this this market boom, it seems to be spread a little bit further. I like the fact that the regional areas have picked up some price growth. Historically, they go up and down a little bit more than not, but I certainly don't think we're in a bubble at all. Finally, I just want to add that there's two types of property, residential property we're talking about here. And one is the raging completed stock, and then there's the off the plan stock. So and then in that category is house and land as well as apartments. And that's where the foreign investment is really critical and important to our economy to make sure other people benefit and from that.
Right. Okay, Peter, there's another question from a participant, and they are saying that they have 1 to 3 million to spend on a residential property with a view of being in 3 years' time. Where and what type of residential property should they invest in to get the greatest capital appreciation?
Well, obviously where there's underlying and consistent demand over a long period of time, we can look at the numbers, but if you talk about, I'll just talk about Sydney for the time, but there's many places in all of our capital cities. But for that sort of money, around the beaches or lower North Shore, we'll always see growth because they're hard markets to get into. Right now, if you go to an auction in any of those areas, they're 90% clearance rates and they're going well above reserve. So they're hard to get, and the best properties to buy are the ones that are hard to get because then they're going to be the best ones to sell down the track. So I'm not giving specific suburbs, obviously, because it changes all the time. But if it's hard to get, it'll be the right one to go for. So you've just got to stick with that approach. And arguably at this point of time, you've got to pay more than what you want to. But we always recommend you have a medium to long-term hold strategy. And then you're most likely to get a benefit from it.
All right, okay. Sam, can I ask you one question on the vulnerability of banks? Because that will also play a very important role. Do you think that the state of economy and the vulnerabilities associated with some of the stimulus that the government had introduced last year, JobKeeper and other things, are banks in softer position compared to what they used to be in the past? Would that have an impact?
Would the fiscal stimulus have an impact? Is that what you're asking, or?
I'm asking you the question that a lot of support that was given by the government in the last year has supported households to pay their mortgages, pay their bills. But once they are taken off, there might be some softer edges. And do you think that once the forbearing, which banks had applied last year by deferring the mortgages and all those kind of incentives which they offered, would that change in the coming future, and would that make the banks more vulnerable?
Well, it's always a possibility, but I don't think the banking sector right now is at any risk of significant instability. So at the current time, growth rates of housing credit at about 3.5%. Whilst they have been rising over the past few months, that's still well below what we saw, say, in 2015, where it was more than double that. So I don't think banks are lending at inordinate rates. That said, well, I would have to qualify my answer by saying the issue of financial instability depends. And by depends, I mean in the presence of a very large shock, say a housing demand shock that could push prices down, then there may well be issues of instability. Now, I don't want to posit specific numbers at which stress tests would show that the financial sector is unstable, but I don't think right now there is an issue of instability. And I suspect that even if house prices fell by 5-10%, there would be little impact on the stability of the financial sector. There would be an impact on the profitability, no doubt, but not on the stability of the sector.
NERIDA, a few months back when we spoke on residential market, you said that like this is not a financial crisis and hence the housing market would sustain themselves. So do you concur with your views then, and it still remained robust in that sense?
Yeah, look, I mean, at this stage, it does. I mean, it certainly showed through that it wasn't a financial crisis, and, you know, banks have got tons of cash and, you know, they're lending freely. So it was a productivity crisis. If we have a look how it hit the property market, it was mainly the rental market that got hit very badly. We also saw that it was mainly young people that became unemployed. It was very sectoral specific, education, hospitality and tourism. So, you know, there's certainly this level of, there was, you know, very much a level of concern of what would happen during the pandemic to house prices, but it certainly didn't play out.
All right, okay. Thank you very much. I think I would pose the last question, given that we are almost at 1 p.m. First to Rod. Rod, what advice would you want to give to Australian government in relation to policy changes that are relevant to foreign investment in Australian property market, Australian residential property market, to be specific?
Well, probably a few comments. One would be, I think the idea of channeling foreign investment into new construction is a positive. And I think policy instruments that do that are supportive, if you like, of the job generation, job creation process, and adding something constructive to the community. I think we need to get our coordination between state and federal messaging and taxing, because taxing is a pretty significant message. I think we need to get that better coordinated between federal and state, because as far as I knew, we were still one country, not seven. And as a consequence, I think the sort of messages that foreign investors receive from different parts of Australia via state governments, and the inconsistencies with the messaging coming from federal government and the broader investment perspective that Australia is an open and transparent and safe sovereign risk. I think we need to get better coordinated in that regard, so that there's greater, if you like, consistency in the messaging we're sending. And thirdly, I think the removal of these anomalies, the legislative anomalies that are a reflection of hasty policy and legislation implementation to effectively make money out of foreign consumers, which is, I'm quoting a treasurer of a state that will remain nameless, that's exactly why these surcharges were introduced. The fact that it caught the producers as well is a byproduct, but it's a beneficial byproduct. And that really is the last policy suggestion I would make, and that is encourage the production process, and if you must tax, then tax the consumption process.
Right, okay. And Peter, from your experience in the sales side, what would you see as the policy advice that you would like to offer to the government?
Yeah, you've got to encourage work, jobs, and to make it harder to encourage jobs is not the right thing to do. So, you know, you want to get to a situation where, yeah, people are active in the market, doing things, and you pay your taxes, but you shouldn't be putting these barriers up. I don't believe that by trying to stop natural flow of the marketplace will have any term benefits at all, except for short term to try and be a political fix. So it's okay that the property markets are a little bit more expensive in some spots, and it's okay that that means that other areas become more affordable, and therefore they've got more growth potentials. So I just look for more consistency. I look for tax base that encourages jobs, and therefore all the other benefits that come along with it, and that improves everyone's lifestyle.
Right, right. Sam, what would your views be on that, particularly when we are looking at, say, for example, the changes that happen with regard to responsible lending regulations, or there may be some other ways of clamping the banking credit. So do you think that there are some advice that you would want to offer to the government should they
Well, I'm going to say,
restrain themselves?
I'm going to recommend advice that's not specific about the property sector, more general. I think the government should continue to think about fiscal stimulus and supporting households. There still are a significant number of households that are experiencing distress, for example, rental distress. And I think it's good for the government to continue focusing on helping those types of households.
All right, okay. NERIDA, final words from you. What would you like to advise to the government?
Sorry, was that Piyush?
What would be your advice to the government on their policy?
Yeah, look, I suppose most generally is around migration. You know, I think we, on one hand, you know, we do have a very strong housing market at the moment, but it is being driven by wealth, and it's also being driven by access to finance. I think, you know, for Australia's economy and also for housing and for development more generally, we do need to ensure that that migration does pick up again once borders open. So I think that's the biggest concern at this stage.
All right. With that, we would like to close this discussion. Thank you, everyone, for joining us today, and thanks to the panelists for such an insightful discussion. I would request the things to be online for you, like from you, which may be of their interest. So please take a moment to take note. And thank you very much, everyone who has joined us today, particularly the panelists who gave their valuable time. Thanks a lot.